Chapter 23, Flexible Budgets and Standard Cost Systems. We're going to prepare flexible budgets and performance reports using static and flexible budgets. Identify the benefits of a standard cost system and understand how standards are set. Compute the standard cost variances for direct materials and direct labor. Compute the standard cost variances for manufacturing overhead. Describe the relationships among and responsibility for the product cost variances. Record transactions in a standard cost system and prepare a standard cost income statement. So preparing flexible budgets and performance reports using the static and flexible budgets. Managers use budgets for planning and controlling business activities. The master budget focuses on the planning step. Just note that. The controlling step. It's okay. The controlling step focuses, at least we know the volume's working. The controlling step focuses on the decisions managers make during and after the budgeting period based on the actual results. So here we have a diagram. How do managers use budgets to control business activities? So we see here, we get feedback from customers or employees on pretty much anything related to your business. And that's how managers can develop strategies to improve certain processes or areas. We put a plan in place for those improvements. The financial plan you see here is the budget. We're looking at our revenues and our expenses, and then we put everything into action to make processes better and to better control our finances. And it's just a circle, just continues to go around and around. We then get feedback, what's working, what's not, what should we improve, develop the strategy, plan it out, put it in the budget, act on it, and then just one big circle. The master budget is a static budget, which means it's prepared for only one level of sales volume. A variance is the difference between the actual amount and the budgeted amount. And a static budget variance is the difference between actual results and expected results. You can have favorable variances and unfavorable variances. So a favorable variance is something that is good for you, and an unfavorable variance is something that is not good for you. So if an actual amount increases your operating income, that's favorable. You would like to have a higher operating income because that means your income is higher. If the actual amount decreases your operating income, then you're making less income than you thought you would, and therefore it's unfavorable. Examples of that is actual revenue greater than budgeted revenue is favorable. So actual is higher than budgeted revenue. Or your actual expenses were less than your budgeted expenses. So what you thought your expenses were going to be actually ended up being less than what you thought, therefore you're happy. That's extra money in your pocket. And then the opposite of those is going to be unfavorable. So your actual revenue is less than what you budgeted, or your actual expenses were greater than what you budgeted, are unfavorable. So this is an example of a static budget performance report. And here we're looking at cheerful colors. This is for the year ended December 31st, 2017. And we have here their actual results, their static budget, and then whatever their static budget variance is. So we budgeted in our static budget, we budgeted our sales revenue to be $375,000. But then at the end of the year, we got our actual results, and our sales revenue was actually $384,800. So actual revenue was higher than what we thought it was going to be. So that's going to be favorable because we're talking about revenue. Our revenue was higher. We made more money. It's favorable. And then the difference between the actual revenue and the static budgeted revenue, that's going to be our static budget variance. So the $384,800 minus $375,000 equals $9,800. Then when we look at, we'll look at supplies. So for supplies, we budgeted, our static budget amount for supplies was $18,750. However, our actual results for supplies was higher than that. It was $19,200. So we budgeted $18,000 to spend on supplies, but we actually spent $19,000 on supplies, so we spent more than we budgeted on supplies. Therefore, we have an unfavorable variance, and the variance is $450. The $19,200 minus $18,750 gives us $450, which is our static budget variance. And because actual was higher than what we budgeted for supplies, it's unfavorable. And that's how you would work through all of these. Selling and administrative, this is also an expense account. So we budgeted $22,000, but our actual results were $25,000. So this expense account is higher than what we thought it was going to be. So it's unfavorable. We're not happy. We spent more than we thought we were going to spend. So it's unfavorable, and the difference is the difference between the two, which is $3,100. Yes, sir.
What does the U and F stand for on the side of the numbers?
The U is unfavorable and the F is favorable.
Oh, thank you.
Yep, no problem. Preparing flexible budgets. A flexible budget summarizes revenues and expenses for various levels of sales volume within a relevant range. Flexible budgets separate variable cost from fixed cost, and the variable cost puts the flex in the flexible budget. A flexible budget needs budgeted selling price per unit, variable cost per unit, total fixed cost, and different volume levels within the relevant range. When we're looking at variable cost per unit, we're going to have product cost and variable selling and administrative expenses. So here we're preparing flexible budgets. We have a flexible budget. This is for cheerful colors as well. And so on their budget, we have the budgeted amounts. So for sales revenue, per unit budgeted amount is $7.50. So we expect for each unit that we sell, it's going to be $7.50 of revenue. And the units, which are in batches of 100, the units are listed up here. So if you take $7.50 times 48,000, that should give you the 360,000. If we look at our direct materials, for direct materials we have 1.75, amount per unit, direct labor, variable overhead, same process of multiplication, units times amount per unit equals total amount for the units. Then it lists here, it shows you your total variable cost. You would add all of these together to get your total variable cost, subtract out any of your expenses, contribution margin. Then you've got your fixed costs. These are the costs that do not change. They're fixed. They're always the same. And then your fixed costs. So you'll see here, no matter how many units we make up here, no matter how many units, these costs are still the same thing. They don't change. Manufacturing, selling, and administrative, add those together to get your total fixed cost. And then you would subtract this cost from your revenue to give you your operating income. So managers want to know why a variance occurred. So a lot of times, you know, you're looking, when you're creating a budget for the next year. If it's your personal life, you might be creating a budget for something you plan to do in your personal life. It can be something you plan to do. You're budgeting money to go on vacation in 2 months, or you're budgeting money to get braces. I don't know. So, but you know, we budget money in our personal lives. We budget money in businesses. Let's say that you are budgeting money for vacation in 2 months. You're like, okay, I'm going to need $2,000 to go on this vacation in 2 months. I can get that as long as I'm, you know, getting an extra $1,000 a month here and $1,000 a month there. And then at the end of those 2 months, you got $1,500 instead of $2,000. And you're like, well, why? Why is there a variance of $500? Because you have a variance of $500. You were supposed to have $2,000, but you ended up with $1,500. So the variance would be the $500 difference. So then you have to figure out why. And the reason you want to know why is, you know, you did your research, created this budget based on information that you had at the time that you created it, and something along the way changed, which made you not reach your budgeted amount. And that's why you have a variance. And in the case of going on vacation, maybe you had to replace the tires on your car that were unexpected. That was unexpected. You paid $500 for some new tires. So now that caused you to miss your variance. A company wants to know why they're missing their variances, why they have variances. Is it something that they can control or not? You know, so, or is it just maybe it was a bad budget? You know, maybe whoever, you know, it was created and it was created on bad information or information that wasn't, you know, fully accurate. And that helps them to know how to create their next budget going forward and stuff like that. So they want to know why a variance occurred. With a flexible budget variance, this is the difference between the actual results and the expected results in the flexible budget for actual units sold. The sales volume variance is the difference between the expected results in the flexible budget for the actual units sold and the static budget. And we'll see these in problems that will help make more sense. So here we have budget variances, your static budget variance, you have actual results, the flexible budget, and the static budget. The flexible budget is based on actual number of units sold. The static budget is based on the expected number of units sold. When you're looking at your flexible budget variance, this is just looking at the actual results and the flexible budget. It's not looking at static. When you're looking at your sales volume variance, it's looking at flexible budget and static budget. This is not looking at actual results. So that's what these colors mean down here. Actual and flexible help you determine your flexible budget variance. Whatever the difference is between these two is your flexible budget variance. And then the difference between your flexible budget and your static budget, that's your sales volume variance. So here we have our performance report, and we've got the budget amounts per unit. Again, we saw part of this earlier in that previous slide, so I'm not going to go through all of this. But we've added in some columns. So our actual results and then our flexible budget variance here. And it's telling you to get this column, you take column 1 minus column 3. 1 minus 3 gives you your variance. This is column 1. Your actual results are column 1. Your flexible budget, this is column 3. So if you take column 1, 104,000, minus column 3, 91,000, gives you the difference of 13,000. This is your variance, your flexible budget variance, because you took actual minus flexible budget, which gave you your flexible budget variance. And then we're looking at materials, direct materials. This amount is greater than this amount. Our actual was higher than our budgeted. So because actual was higher than budgeted, it's going to be unfavorable. If we look up here and we look at our revenue account, so our actual revenue was less than our budgeted revenue, so that is also unfavorable. Why? Because actual was less than what we thought we were going to get. So we're not happy. We didn't get as much money as we thought we were. So that's why that's unfavorable. And that's how you would review all of these. Just going through. I would definitely look back at the slide, make sure that you understand what's going on, and just look at it, just like that. What account am I looking at? Is this a revenue account or is this an expense account? And then paying attention to, direct labor. So our labor was 145,000 actual, and in our flexible budget, we budgeted it at 156,000. So actual labor expense was less than what we thought it was going to be, so we made money on that. Therefore, it's favorable, and the difference between the two is $10,400. So that's looking at the flexible budget variance. Now we're going to move down to the sales volume variance. So the sales volume variance is telling you here, take 3 minus 5, so flexible budget minus our static budget. And so right here looking at revenue, our revenue that we budgeted in our flexible budget was 390,000. Our static budget was 375,000. So our flexible budget, our revenue is higher than in our static budget. Because our revenue is higher in our flexible budget, we have a favorable variance, and the difference between the two are the 15,000, and that's our sales volume variance. So we have a favorable sales volume variance of 15,000 for sales revenue. And then when we look down here, direct labor. So for direct labor, our flexible budget for direct labor is 156,000. Our static budget for direct labor is $150,000. This is an expense account, so it's opposite the revenue account. So our flexible budget for direct labor is higher than our static budget. Expenses are higher here. We don't like that. It's not good. It's unfavorable. And the difference between the two is 6,000, and that is our sales volume variance of 6,000 for direct labor. And then once we have done this for all the accounts that we have, we've made the calculation. So we entered our actual results, we entered our flexible budgeted results, we entered our static result, our static budget. Then we went in and we figured out the differences between actual and flexible to give us our flexible budget variance. We figured out the difference between the flexible budget and the static budget to give us our sales volume variance. We calculated all this up to give us our operating income. And now that we have our operating income, we can compare the results, the total results. So our flexible budget variance, total flexible budget variance for everything is we have our actual results of 36,000, our flexible budget of 37,000. So actual was less than what we budgeted. So it's going to be unfavorable because we're looking at our operating income account. Actual was less for our income. So it's unfavorable, and it's unfavorable by the difference, which is $680. And we'll do the same analysis over here. So for the sales volume variance, we had 37,000 flexible budget. We have 33,000 static budget. Our flexible budget was higher than our static budget. So, and we're looking at operating income. So because that was higher, this is favorable. And the difference is $3,250. So we have a sales volume variance of $3,250 favorable. And then if we look at the overall static budget variance, the static budget variance, we're going to take the actual results of 36,000 minus the static budget of 33,000. That gives us a difference of 2,250. It is favorable because our actual results for operating income were higher than what the static budget budgeted. And so that's how you would do that. You will see a question or two like this on your stuff, your items. So you will see.
No, the sales volume.
Yes, and this is on slide 16 in the PowerPoint. Make sure that you go through and review this. So for the static budget variance, you're going to take the actual results, 36,320, minus the static budget results of 33,750.
Okay, that's the static budget.
Yes, ma'am.
And then the sales volume variance would be flexible budget minus static budget.
Yes, ma'am.
Okay.
Yep. And yep. And so it kind of shows you down here. So like the flexible budget variance is looking at the actual and flexible. Sales volume variance is looking at flexible and static. And and then the static budget variance looks at actual and static. And there's a previous slide that this one right here might help a little better, just depending on how you want to look at it. So in this one, this slide is showing to get your static budget variance, you're going to take the actual results minus the static budget. To get the flexible budget variance, you're going to take the actual results minus the flexible, and then sales volume is flexible budget minus static. So this might be easier to see. You can use either one. But definitely make sure that you go through the process of calculating and, just think through, why is this favorable or unfavorable? Okay, this is a revenue account, so we want revenue to be high, or this is an expense account, we want that to be low, so that you can determine whether or not it's favorable or unfavorable, because you will have to make that determination on some of your assignments. You will also have to make the calculation for, what is the flexible budget variance, or what is the sales volume variance, or what is the static budget variance. So, maybe one thing that I would suggest, like if you want extra practice work, is maybe going in and, taking like a little sheet of paper or a ruler if it's small enough, and covering up column 2, flexible budget variance, covering up column 4, sales volume variance, and then just going in and trying to fill that in. Calculate what, like use it as a practice problem. So calculate for your direct materials, what would the flexible budget variance be? Well, you know that direct materials is 104,000. This is blocked off, you can't see it. And then your flexible budgeted amount is 91,000. And then you would sit there and you would say, okay, well, is this favorable or not? And what's the difference? And then you plug that in and see if you got it right, because you've got the answer right here. But you'll also see some stuff like this on your homework as well and your practice problems. So. All right, so learning objective 2, identify the benefits of a standard cost system and understand how standards are set. Most companies use standards to develop budgets. A standard is the price, cost, or quantity that is expected under normal conditions. A standard cost system is an accounting system that uses standards for product cost. Standard setting issues. So here we have some cost standards, and we also have some efficiency standards. And this is just telling us what are some of the issues that we could run into. So when we're looking at direct materials cost standards, the purchasing manager is the person who is responsible for ensuring that our cost standards are right for direct materials. Some factors that they look at to determine that is, what was the purchase cost? How much did it cost us to purchase this? Were there any discounts? Are there any delivery requirements? And are there any credit policies? Cost standards for direct labor. The human resources manager, he's responsible for that. When you think of like direct labor, employees report to HR, which is human resources. So the human resources manager is responsible for direct labor, not the store man, not the warehouse manager, the human resources manager. And some factors that they look at are wage rates based on experience requirements, payroll taxes, and fringe benefits. Cost standards for manufacturing overhead. The production manager is responsible for that. Think of manufacturing overhead, think of a plant, or, think of like a plant where they're producing items. A production manager producing, just in case you see anything like this with identifying who is responsible for this task. So for manufacturing overhead cost standards, the production manager looks at the nature and amount of resources needed to support activities such as moving materials, maintaining equipment, and product inspection. When we move over to efficiency standards, for direct materials, efficiency standards are the responsibility of the production manager and engineers. And some factors that they look at are product specifications, spoilage, and production scheduling. For direct labor efficiency standards, The production manager and engineers are responsible for that. Some factors that are looked at are if there are any time requirements for the production level and employee experience needed. And then for efficiency standards for manufacturing overhead, it's the same as cost standards. Again, the production manager oversees the efficiency standards for manufacturing overhead, and factors include nature and amount of resources needed to support activities such as moving materials, maintaining equipment, and product inspection. Standard cost calculations. So here, this is a good slide to refer back on. Anything that has to do with calculating anything, you're probably going to see something similar to it. So definitely, refer back to this slide. This is slide 20. So it says direct materials cost standard for paraffin. They have a purchase price, which is net of discounts, of $1.65 per pound. And then the delivery, receiving, and inspection was 10 cents per pound. So their total standard cost per pound is $1.75. For their direct labor cost standard, we're looking at wages, labor. So our hourly wage of $10 per direct labor hour. Plus we have payroll taxes and fringe benefits of $2 per direct labor hour equals our total standard cost per direct labor hour of $12 per direct labor hour. Variable overhead cost standard. To calculate the variable overhead cost standard, take estimated variable overhead cost divided by estimated quantity of allocation base. That's a formula. So they took the 37,500 divided by the 12,500 direct labor hours, and that gave them $3 per direct labor hour. For your fixed overhead cost standard, another formula, you're going to take estimated fixed overhead cost divided by estimated quantity of allocation base, and that's going to give you $2 per direct labor hour in this example. So efficiency standards, managers, production managers, and engineers set direct materials and direct labor efficiency standards. Labor standards are established from analyzing the production process. Efficiency standards are based on best practices called benchmarking. Standard costing helps managers to prepare the master budget, set target levels of performance for flexible budgets, identify performance standards, set sales prices of products and services, and decrease accounting cost. So here we are looking at our cost and efficiency variances. We have our actual cost, standard cost, standard cost. So actual cost times actual quantity gives us our cost variance. Standard cost times actual quantity gives us our cost variance. Standard cost times standard quantity allowed, efficiency variance, and then the cost variance and efficiency variance give us our total product cost variance. A cost variance measures how well the business keeps until a cost variance measures how well the business keeps unit cost of material and labor inputs within standards. The cost variance is the difference in cost of an input multiplied by the actual quantity used of the input. So our cost variance equals actual cost times actual quantity minus the standard cost times actual quantity. And then we'll take our actual cost minus our standard cost times our actual quantity. So AC, actual cost, minus SC, standard cost, times AQ, actual quantity. So if you see something like this, this is what they're talking about. So, but to get your cost variance, you take actual cost minus standard cost times actual quantity. An efficiency variance measures how well the business uses its materials or human resources. The efficiency variance is the difference in the quantities multiplied by the standard cost per unit of the input. And so this same thing, so they're showing us here, our efficiency variance is our actual quantity minus our standard quantity times our standard cost. So cost variance was actual cost minus standard cost times actual quantity. Efficiency is actual quantity minus standard quantity times standard cost. And then here we just have, this is showing us the relationships between the different variances. So again, actual results to static budget is our static budget variance. Actual results to flexible budget variance. Flexible budget to static budget, sales volume variance. And then when we're looking at our flexible budget variance, within that we have our cost variance and our efficiency variance. Yes, sir.
Could you go back to the previous page before this one?
Yes,
Thanks.
no problem.
I just wanted to screenshot.
Okay. So learning objective 3, compute the standard cost variances for direct materials and direct labor. So here we have our flexible budget variances for production cost. We've got the budget amounts per unit. We've got our actual results, our flexible budget variance, and our flexible budget. So this is a small portion of what we just looked at. This is a smaller picture. So right now we're only looking at our flexible budget variance. So we've got our direct materials, the actual direct materials of $104,000, the flexible budget direct materials of $91,000. Actual is higher. This is an expense, so it's unfavorable, and it's unfavorable by the difference, which is 104 minus 91, which is 13,000. The direct materials cost variance is 97,050 favorable. So, sorry. So we have our direct materials cost standard, which is $1.75 per pound. Direct materials efficiency standard of $1 per batch. The actual amount of paraffin purchased and used was 65,000 pounds. Actual cost was 104,000. So to find the direct materials cost variance, they took the actual cost minus the standard times the quantity, and that gave us $1.60 per pound minus $1.75 per pound equals 65,000 pounds. And that gave us 97.50 favorable. The direct materials efficiency variance is 22,750 unfavorable. The variance is unfavorable because workers used more paraffin than they planned for the crayons. So direct materials efficiency variance, we took 65,000 pounds minus the 52,000 pounds times $1.75 per pound, and that gave us 22,750 unfavorable. This is just another way to show that. So they put the calculation here in each box to show you where that would go on a diagram. And then we have our cost variance, 97.50 we saw in that previous slide. And then in the last slide we looked at the efficiency variance the 22,750. So to get our total direct materials variance, it's going to be the difference between the cost variance and the efficiency variance. And the efficiency variance is higher, unfavorable, so it's going to be an unfavorable variance. So we've got the difference between these two of 13,000, and this one is higher, unfavorable, so it's going to be unfavorable. So for here, this one, the direct labor cost variance is 20,800, unfavorable. And to get that, what they did was we have our direct labor cost standard of $12 per direct labor hour, direct labor efficiency standard of 0.25 direct labor hour. The actual amount of direct labor hours was 10,400. The actual cost of direct labor was 145,600. So our direct labor cost variance is $14 per direct labor hour minus $12 per direct labor hour times the 10,400, and that gave us 20,800. And then this is our direct labor efficiency variance. So 31,200 favorable. The direct labor efficiency variance is favorable because laborers worked fewer hours than budgeted. So if you flipped back to that previous slide with all the information on it, it was under budget, so it's favorable. And then this is showing you how they calculate that. So they took the 10,400 direct labor hours minus the 13,000 direct labor hours, multiplied that by $12 per direct labor hour, and that gave them 31,200 favorable direct labor efficiency variance. And again, this is just showing you where those would go. It comes down into our cost variance and our efficiency variance. The difference between the two is 10,400 total direct labor variance, and this one is higher, it's favorable, so this one will be favorable as well. Compute the standard cost variances for manufacturing overhead. So how are standard costs used to determine manufacturing overhead variances? The terms manufacturing overhead and overhead are often used interchangeably. The total overhead variance is the difference between actual overhead cost and standard overhead allocated to production. In a standard cost system, the manufacturing overhead allocated to production is to determine your overhead allocated to production, you would take your standard overhead allocation rate times your standard quantity of the allocation base allowed for the actual output. The approach to analyze the variable overhead flexible budget variance is similar to the approaches for the other variances. The information to calculate the overhead variances is as follows. So they're giving us a list of information here to do our calculations. And so then we're going to plug those numbers in to find the variable overhead cost variance. So the $290 per direct labor hour minus $3 per direct labor hour times 10,400 direct labor hours gives us 1,040, and that is favorable because they paid less than they expected for their variable overhead. Calculate the variable overhead efficiency variance. So we'll take the 10,400 direct labor hours minus 13,000 direct labor hours times $3 per direct labor hour gives us 7,800, and it is favorable because laborers worked less than they were expected. Same thing here. They are showing us our different equations that we just went through, and then We're figuring out our cost variance based on the difference of these and our efficiency variance. And then once we have our cost variance and efficiency variance, we can then determine the total variable overhead variance, which is the difference of cost and efficiency. Efficiency is, well, they're both favorable in this case. But whichever one is higher, that's the one that you would go by. So this is favorable by the difference, which is 8,840 because they're both favorable. So you're adding these together. The approach to analyze fixed overhead variances differs from the process used for the variable cost variances. To analyze fixed overhead cost, we need the actual fixed overhead cost incurred, the budgeted fixed overhead cost, and the allocated fixed overhead cost. The fixed overhead cost variance measures the difference between actual fixed overhead and budgeted fixed overhead. The fixed overhead cost variance is going to be actual fixed overhead minus budgeted fixed overhead. The fixed overhead volume variance is the difference between the budgeted fixed overhead and the amount of fixed overhead allocated. So the overhead allocated to production equals your standard overhead allocation rate times the standard quantity of the allocation base allowed for actual output. So in this example, they took $2 per direct labor hour times the amount of direct labor hour per batch times the number of batches, and that gave them the direct labor hours. So now we have 13,000 direct labor hours. They multiplied the $2 per direct labor hour to the 13,000 direct labor hours, and that gave them 26,000 overhead allocated to production. The fixed overhead volume variance is budgeted fixed overhead minus allocated fixed overhead. So they took the budgeted minus the fixed, and that gave them a difference or a variance of 1,000. Budget was less than actual, so it's going to be favorable because we're looking at the fixed overhead volume variance. And this is a diagram just showing you kind of more detail. So you've got your favorable volume variance and any unfavorable volume variance. I'll let you guys kind of look at that on your own time. Same thing that we've been looking at. So learning objective 5, describe the relationship among and responsibility for the product cost variances. What is the relationship among the product cost variances and who is responsible for them? So again, we've got our budget amounts per unit, our actual results, our flexible budget, and then the difference of these two gives us our flexible budget variance. And we determine if it's favorable or unfavorable based on the type of account that it is. Product cost variance relationships. So we have total production cost flexible budget variance of $7,320 favorable. We've got our total direct materials variance, our total direct labor variance, and our total manufacturing overhead variance. And then from those variances, we can get, so from our total direct materials variance, we can then determine what our direct materials cost variance is and our direct materials efficiency variance. Our cost and efficiency variance is for direct labor. Our overhead variance and for variable overhead, and our overhead variance for fixed overhead for our manufacturing overhead variance. And then once we figured out these two, our variable overhead and our fixed overhead, we can then determine what our variable overhead cost variance and variable overhead efficiency variance is based on variable overhead. And for our fixed overhead variance, we can determine our fixed overhead cost variance, which is the same as this one. So this company should investigate the variances that they think are significant. And hold on, go back one more. All right, so like for instance, what they mean by significant, and every company is different. So you know, if you have a really big company and you have some companies, you know, you could have a $50,000 variance, and the company's like, it's not material, it's not a big deal. You know, we're in the billions, $50,000 is nothing to us. We're not going to worry about that. Okay, and then other companies, you know, it's like, well, that's a lot of money. You know, let's say we're going back to our vacation, and we're trying to save $2,000, and our variance is only $500. So $500 is not a lot, but it is to us because overall, you know, we're looking at $2,000, and so technically that's a fourth of what we were looking at. So, you know, everybody's different, every person, every company. But what I would probably say is just looking at this, maybe like if you had to like determine if any of these were, so we've decided we're going to look into some of these. Which ones would we probably look into? Like which ones should we look into first? Or are there any that should we not look into any of them at all? So our flexible budget variances, we've got 13,000, 10,000, 8,000, and 1,000. Should we look into any of those?
We're 13. So we're 13.
Yeah, that's one I was thinking is unfavorable. It's still arguing.
Yeah, that's a good observation.
That's good. Actually, okay, well, that is good because that's the budget 91,000, actual results 104,000. I was looking at favorable and unfavorable, just looking at the UF and 10,400 here, actual results 145,000.
So we're saying we definitely want to look at this one because this one is unfavorable.
Right.
Okay. Are there any others that we might want to look at?
10,000.
Yeah. It's favorable, but there's a big difference here. So, like both of those actually. So even though it's good for us, we still we also want to know what was good. Yeah. Because then, you know, I mean, we might want to do this again next year or something. Incorporate this into our plan because it wasn't in our plan before. And the reason we don't think it was in our plan before is because we budgeted based on prior information, and we budgeted, you know, our budget was different from actual, and this was a good thing. So we want to know what actually happened to make this 10,000 favorable or this 8,000 favorable. You know, again, it depends on the size of the company, but like smaller numbers, even favorable or not, it's really kind of like to your discretion. And also it could be like a timing thing. Like if you have deadlines and stuff and you don't really have a lot of time to look into these things, but you know that they need to be looked into, start with the one that's the biggest and work your way down.
I just noticed that, well, I would say it like a million times already, but so the flexible budget, that's what we have right now. We have this in our budgets right now. This is ours right now. But then the flexible budget variance is how much we're spending out of that budget. And that added to or subtracted from gives us the actual result. Or am I looking at that wrong? Because I just
So,
156 and subtracted it from 10,000, the second problem here. And got 146,600, which isn't exact, but, you know, it's,
so the difference between your flexible budget and your actual results is your flexible budget variance. So if you take 156 minus 145, 600, that should give you 10,400. So at the very beginning, like at the beginning of the term or whatever it is, going back to the vacation thing, because summer's coming up and all. So in May, we are going to budget. I should put that a little further down so that it's aligned with your PowerPoint. So in May, we budgeted, okay, we think it's going to cost us $2,000 to go on vacation. And then it's July now. And our actual vacation in July was $1,500. So we budgeted $2,000 and we held on to that $2,000 in a savings account or in our piggy bank or under a mattress or wherever you put your money. We held on to that, and then when we actually went on vacation, it was $1,500. And so, what would our variance be?
500?
The variance would be 500. I'm just going to write it down, or I'll write it in the middle. So the variance is 500. And is it favorable or unfavorable? Favorable. And it's favorable because we have an extra $500 in our pocket. We thought it was going to be this, but it wasn't. And now we have an extra $500. I hope that helps. And it would work the same, like, let's say that, we budgeted 2,000, but actually it ended up being 2,500. So then now we have a $500 unfavorable variance, and we had to figure out where to get that extra $500 so that we could still go on vacation. Or we had to cancel our vacation, or we had to push it back, or
just find something cheaper.
Yep. So. So anything that they think is significant, they should investigate. Again, it depends on the size of the company. But it can be favorable or unfavorable. So not just unfavorable. Management by exception occurs when managers concentrate on results that are outside the accepted parameters. Managers focus on exceptions, and exceptions are either a percentage or a dollar amount. This breaks down management by exception a little better. So if we have a direct materials cost variance, the purchasing manager is the one who is looking into that. And some questions that they might ask are, how were you able to purchase paraffin at such a reduced cost? How did you compromise on quality, and will you be able to continue purchasing at this amount, or was this a one-time deal? Direct material efficiency, production manager. Some possible questions would be, why did the production workers use more paraffin than they expected? Was there a problem with quality? Did you have inexperienced workers that caused excessive waste? Was there some event such as a large spillage that caused the variance? Direct labor cost would be human resources. Some possible questions are, why were workers paid more than they were expected? Did the workers hired have advanced skills? Did an increase in fringe benefits cause the labor cost to increase? And then direct labor efficiency would be the production manager. How were workers able to produce batches faster than expected? Are workers more experienced or better trained? And can this level of production continue? And then variable overhead efficiency, production manager. Variable overhead was allocated on direct labor hours. Therefore, the possible questions for the direct labor efficiency variance also apply here. Record transactions in a standard cost system and prepare a standard cost income statement. Using a standard cost system simplifies the recording process because entries are made at standard cost. Variances are recorded as soon as possible. Cheerful Colors records a debit to raw materials inventory for the standard price for the paraffin, 65,000 pounds times $1.75. The favorable variance of 9,750 is also recorded. And so this is showing you what that journal entry would look like. So we have,
And I would like the extra money that you paid over.
yes, yep. So we have a debit to raw materials inventory of 65,000 pounds times $1.75 a pound, which is 113,750. We're going to credit our accounts payable of 65,000 pounds times 160, which is 104,000. And the difference between the two is our direct materials cost variance of 9,750. And the note, we purchased direct materials. When material is transferred to the work in process inventory account, the amount at standard cost is the debit, and the unfavorable efficiency variance is recorded. And then this is showing you how we will record that. Debit work in process inventory, debit direct materials efficiency variance, credit raw materials inventory. Work in process inventory is debited for the standard cost of the 13,000 direct labor hours. Wages payable is credited for the actual cost paid to employees, and the unfavorable direct labor cost variance is recorded along with a favorable efficiency variance. So we debit work in process inventory, debit direct labor cost variance, credit direct labor efficiency variance, and credit wages payable. Manufacturing overhead is debited for the actual fixed and variable cost of $54,080. We're going to debit our manufacturing overhead and credit various accounts. And that was just a shortened way of putting the credits for their variable. The amount of overhead allocated and recorded to work in process inventory. So we're debiting our work in process inventory account and we're crediting our manufacturing overhead account for manufacturing overhead costs allocated. The standard cost of the 52,000 batches of crayons completed is transferred from work in process inventory to finished goods inventory. So to record that transfer, we're going to debit finished goods inventory and credit work in process inventory. The crayons were sold during 2017, so the standard costs are transferred from finished goods inventory to cost of goods sold. We're going to debit cost of goods sold, credit finished goods inventory for the cost of sales at standard cost. Transaction 8, the manufacturing overhead account is adjusted and the overhead variances are recorded. So to adjust our manufacturing overhead, we're going to debit the manufacturing overhead account, and then we're going to credit our variable overhead cost variance, variable overhead efficiency variance, fixed overhead cost variance, and fixed overhead volume variance. And this is showing the T accounts for the journal entries, and so the accounts that were affected in that process. It also shows you what transaction it was. So like for instance, transaction 1 is that this is showing you the debit to raw materials. And then the opposite side, we've got our credit to accounts payable for transaction 1 and our direct materials cost variance transaction 1. So these are all the T accounts and what they look like, and they've entered in all the different transactions here so that you see what that looks like. Notice that the inventory accounts have a 0 balance at the end. That's because we assumed that this company used all the materials that they purchased and completed all the units that they started and sold all the units that they completed. So that's why they have a 0 balance. And then the standard cost income statement. So this is showing us what their income statement would look like. We've got their sales revenue at standard, which is so we've got our 52,000 batches at $7.50 each. Gives us a total of $390,000. The sales revenue variance and our actual sales revenue. So our sales revenue standard, our sales revenue actual, the difference between the two is the variance. And then the cost of goods sold at standard batches was $312,000. We've listed in all of our variances here, so our direct materials cost variance, efficiency variance, etc. All these different variances are listed here. Adding those to give us our total manufacturing variance, and then the cost of goods sold, our gross profit, our selling and administrative expenses, and then finally ending at our operating income, $36,320.